Hi, my name is Trey Booth, and today I want to talk about the historic drawdown that we've seen in the bond market. Now, everyone realizes that the equity market had a bad year in 2022, and many investors realize that with rising rates, bond prices went down as well. But what's not really as clear is how detrimental that interest rate environment has been to the bond market as a whole. And so we felt like it'd be good to kind of pull the curtain back and look over a long period of time. And so to do this, we wanted to look at the U.S. bond aggregate index. And so that's an index that's used to track the U.S. bond market. And going back to the 1970s, you can see here that the bond market typically doesn't have very many instances where it loses value. Sometimes the price go down, but interest will more than cover that loss. And last year's loss of 17.18% was by far the worst occurrence. As you can see on this chart, over the last 50 years, that 17.18% drop in value of the bond market is historic, not only in the depth of that drop, but also the fact that we have yet to recover that loss. To date, the longest period it took to recover a loss was 16 months back in the 1970s. And we're still far away from an all-time high. So what the Federal Reserve did in 2022 and 2023 to impact the bond market really hit home with directly the bond ag, which is where active management comes into play, which is why it's always important to watch what is happening in the market and to be proactive and resilient. So while higher interest rates are helping savers now, the move from low interest rates to higher interest rates had a historically negative impact on the bond markets and something we're still watching for a recovery. I hope you found this information helpful and informative. Please don't hesitate to call. There's a lot more to this data. We'd like to talk with you on a one-on-one basis. Thank you so much.